New research from American Compass reveals how a majority of Wall Street's publicly traded companies return record amounts of money to shareholders instead of making investments that they need to grow their business. Author and executive director at the American Compass, Oren Cass, joins us now to discuss the declining rates of nationwide investments. Good to see you, Oren. Thanks for joining us, man.
Thanks so much for having me.
So tell us a little bit about what you guys found in this report on actual Wall Street behavior.
Well, there's a story that economists have been emphasizing for a long time, that across the economy, we just see businesses investing less. And that's a huge problem. So we thought, let's actually look at what's happening in the businesses. And if you think about a business, it makes investments, it builds things, it buys equipment, it does research and development. And then over time, it basically uses those up and needs new ones. And so you can look at their financial statements and just see, are they making enough investment every year to more than cover what they're using up? So over time, do they have more stuff to work with, or do they have less stuff to work with? And we basically split everybody up and said, you're a sustainer if you're investing enough to cover what you use up and still you give money back to shareholders, or you're an eroder if you're actually using up your stuff and you're not making enough new investment, you're giving it back to shareholders instead. So you're harvesting your own organs and sending them back to Wall Street. And we found that that's what's happening now. It didn't used to happen, and now it's actually more common than not.
What are the policy implications of this, Oren? Because there's always been a large, these companies, the stock price, and the stock price is reflective of the real economic value that they're creating. What does this tell us both about that narrative, and then what does it mean from a policy perspective about what we should do about it?
Well, I think we have to change how we think about financial markets. The way that we started this project was just thinking about the word investment. And we use it all the time, right? We say private equity invests in a company, or we call a hedge fund manager an investor. But it's really important to realize that when folks are trading things around on Wall Street, there's no actual investment happening. I give you $100, you give me your shares of Intel. We've traded something, but Intel doesn't get any of that money. It doesn't lead to anything actually happening, being built in the real world. And so whereas our assumption, and I think policymakers and economists have always assumed, look, you kind of want to let Wall Street run because the more of this trading they can do, the more efficient they will be, the more capital we can get to companies to invest. The truth is that that's just not happening. Instead, these things are in competition. The more that we let this trading and speculation go on in Wall Street, actually the less investment in the real productive economy is happening. So instead of kind of saying anything goes and let's not interfere, I think we actually have to say, look, a lot of what's going on in Wall Street, it's not just silly, it's actually harmful. Mm-hmm. And we have to have more confidence to say, no, you can't do that stuff. We actually prefer to see real investment going on.
So what happened? You said people used to invest and they didn't. What happened?
Well, I think there were a few shifts that we saw, and this really goes back 40 or 50 years. It's in parallel to what we've seen happening with wages, where wages don't rise the way they used to, productivity doesn't go up the way it used to. And it really goes back to, if you think about the 1980s and the junk bonds and, the original Wall Street and the greed is good speech. Some of that was meant to be entertaining, but along with it was a real shift in economic thinking that goes all the way back to Milton Friedman, who said, look, the purpose of a corporation is to give profits to shareholders. And as that thinking changed, we started to believe the more money you give to the shareholders, the better you're doing. And look, it's certainly true. We should want companies to be profitable and return a profit to shareholders. That's important too. But we started to think that was the end unto itself. And so the way that we rewarded managers, the way the tax code operates, the way that we actually allow buybacks, we say, look, companies can use their money to just buy shares in themselves. And then with that, the rise of hedge funds, the rise of private equity. People found a lot of really smart ways to make a lot of money that didn't create anything of value. In fact, instead, it sort of extracted the value that had already been out there in the economy. And I think, unfortunately, the bill is coming due. Hedge funds stopped performing well a long time ago. They've been underperforming just putting your money in an index fund. Private equity in recent years has found they can't find a whole lot of profitable things to invest their money in. And even if you look at private sector profits, you see those starting to level off. So I think the bill is coming due. And we have to recognize that if we want future prosperity, if we want all those dollars that we see in our investment accounts that we're promising to retirees, if we want those to actually equal real prosperity, we need to get back to investing in the things that create real prosperity.
Yeah, such an important point, Oren. Thank you for the research that you guys do. Nobody else is doing stuff like this. Appreciate you joining us.
Thanks for having me.
Absolutely. Well, more Rising for everybody right after this.